Happy New Year, and welcome to the January 2024 edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be taking a look at the latest trends and market conditions within U.S. and global energy, and sharing actionable insights powered by Vortexa's tracking analytics. In this month's insight, we will focus on Q4 global import demand indicators for gasoline and diesel, how Europe has taken advantage of surging diesel exports from PADD 3, how global crude exports ended in 2023 with a focus on US. We'll look at China's crude demand in December and review indicators that suggest that new import quotas may not spur imminent import surge. And lastly, we'll take a look at how tankers are adapting to the growing problems on the Red Sea and the Panama Canal. While a lot of relevant things happened last year with knock-on effects into 2024 and new issues popping up, the most important current feature and chart is the substantial slowdown in motor fuel import demand over the last couple of months. 11 out of 12 months over the second half of 2022 and the first half of 2023 had shown record arrivals of diesel into the top 100 import ports. And these ports are where at least 90% of all flows are imports, excluding trading hubs. This was driven by the post-COVID recovery, the rerouting of Russian diesel away from Europe, the emergence of replacement supplies, and related stock building ahead of what had expected to be a very cold winter for Europe. Similarly, 6 out of 9 months over January through September 2023 had yielded record imports for gasoline and blending components. The so-called revenge demand after COVID and a string of refinery outages contributed to strong trade flows and high cracks. While over Q3 growth momentum for both gasoline and diesel started to fade, Q4 2023 saw a dramatic reverse of dynamics. For each month over October through December, both gasoline and diesel imports were lower year on year. In the case of gasoline, levels fell close to the 2016-2022 seasonal averages. The observation is a global one, but no regional market is holding up particularly strong. The 3-month stretch is too long to explain with one-off factors or volatility in the trade data. The fact that cracks and the entire market, including structure, have been correcting lower over Q4 clearly highlights demand as the culprit and not the supply side with refinery outages. Likely numerous trends are playing together. The post-COVID recovery is now very likely over, except perhaps for a bit of upside in Asian jet fuel demand. 2 years of strong inflationary pressure in combination with a pretty clear manufacturing recession are leaving their marks. And while energy transition and conservation trends have taken somewhat of a backseat in terms of perception and actual patterns, these factors have not disappeared and may now come again to the forefront more clearly. Finally, with heating fuel demand fading faster than transportation fuel demand, the oil market's seasonality is likely to transition to just one pronounced spike over the Northern Hemisphere summer months. Now let's turn our attention to the crude markets where we see ample supplies despite recent OPEC cuts. The current bearish sentiment on global crude prices does have some fundamental reasoning behind it, as global exports ended December at the highest level since April 2023. Despite month-on-month declines in exports from key OPEC Middle East exporters, Saudi Arabia, UAE, and Kuwait, a sharp rise in non-OPEC exports lifted the global total in December to almost 42 million barrels per day. Russia, including Kazakh origin crude, US and Norway, posted the largest month-on-month gains at 520,000 barrels, 380,000 barrels per day, and 350,000 barrels per day, respectively. Meanwhile, Saudi Arabia, Kuwait, and UAE posted month-on-month declines of around 270,000 barrels per day, 200,000 barrels per day, and around 110,000 barrels per day, respectively. But the diverging trends in non-OPEC and OPEC exports may change in the coming weeks as the latest Saudi OSPs indicate deeper discounts and therefore potentially higher exports. Now let's take a look at the Asian markets and start with China. Will China's new crude quotas prompt an imminent import surge? China has issued full-year crude import quotas for 2024, rather than the usual practice of allocating 50 to 70% of the entire yearly allowance at the beginning of the year. This change is intended to stimulate imports, particularly since many teapot refiners exhausted their quotas in late 2023. However, Chinese state-run refineries, despite having unlimited crude quotas, also scaled back imports in the last 2 months of 2023 due to softened crude demand. In December, China's seaborne crude imports remained below the 10 million barrels per day mark, extending the year-on-year decline for a second consecutive month. Simultaneously, the continuous draws in China's onshore crude inventories since late August slowed down in December, such that the total crude stocks on December 31st remained flat compared to the prior month, indicating persistent softness in the country's crude throughput at refineries. Another important aspect is China's discounted crude imports, which have been slowing despite fresh quotas. In 2023, China set a record for importing Iranian crude and condensate, averaging just over 1.1 million barrels per day and marking a substantial 70% increase from the previous year. Shandong teapot refiners played a key role in driving this surge in purchases and tightness in other discounted feedstocks. The trend emerged after Venezuela diverted some of its supplies to the US and Russia extended supply cuts. However, this momentum has faced headwinds in the last 2 months as teapot demand slumped due to narrowing refining margins and import quotas shortages. Iranian barrels headed to non-Shandong areas also peaked in Q4 2023, with at least 30 million barrels discharged at commercial storage hubs outside Shandong. Now, Chinese state-run refineries outside Shandong continue to exhibit reluctance to engage with this US-sanctioned oil. But with ample Iranian crude storage in place and fresh import quotas allowing the draw of oil from port storage, China's demand for seaborne Iranian cargoes may continue to soften in the coming months. And this is particularly likely if Iran extends cutbacks to China following the increase in crude prices observed in late 2023. Now, if we quickly look at India, we can see that India's implied refinery runs fall in December, while transportation fuel exports rise amid weaker domestic demand. Now, India's demand is expected to pick up later on in the year, but we have yet to see this happen. Now let's move to the issues in the Red Sea and the Panama Canal, and let's look and see how that is impacting flows. Some of the largest companies in the oil and shipping industries are now adjusting operations to avoid transit through the Red Sea. As this situation evolves, it makes sense to understand just how these shifts could impact oil flows and tanker activity. Now let's look at some of the main questions. What is the most commonly transported cargo on oil tankers sailing around the northbound route along the Red Sea? Now, crude, diesel, and gas oil jet cargo are the most commonly carried cargoes. Europe has historically been an importer of middle distillates product from the Middle East and India, and this flow has certainly picked up, especially for diesel since 2022. Volumes of diesel and crude oil sailing northbound have grown sharply on the back of European and U.S. sanctions on Russia, which have boosted the importance of flows via the Red Sea. Now, what is the most commonly transported cargo on oil tankers sailing southbound along the Red Sea? Like tankers moving northbound, crude is also the most common cargo for southbound journeys, but the most common refined products are residual fuel oils and naphtha. Southbound flows are largely dependent on cargo originating from Russia as a result of the mass redirection of Russian Baltic Black Sea crude to mainly India and China, and Russian fuel oil and naphtha to Singapore and East Asia. Well, that's it for the 2024 edition. We look forward to seeing you next month.